Good afternoon, all. I just firstly wanted to thank you all for taking the time to join the call today. We're joined by Dean Orrico and Rob Lauzon, Portfolio Managers for Middlefield Canadian Income. During the call, Dean and Rob will be providing a brief reintroduction to the MCT strategy before providing a quick review of 2023. They'll then be moving on to discuss their outlook for the year ahead and more so highlighting the opportunity set and diversification benefits on offer to investors through Canadian markets. With regard to a bit of housekeeping before we start, all participants will remain muted for the entirety of the call. The presentation will be followed by a brief Q&A session, and could I therefore ask all participants to ask or submit any questions via the Q&A box in the bottom right-hand corner. We will be monitoring these questions throughout the call and look to ensure that all questions are answered, time permitting. If we're not able to answer your question, we'll be sure to follow up with these post the call via email. And with that, I'll hand over to Dean and Rob.
Thanks, Ed. Appreciate it, and thank you for everybody for joining us today. We've got a beautiful day here in Toronto. It's a very warm 17 degrees, very unusual for this time of March. So we can feel the green shoots of spring starting to abound around us, and we're equally enthusiastic about the outlook for the markets as well, because we do think that 2024 is well positioned to be a good year, especially for the areas in which we're focused in Middlefield Canadian. I think this particular graphic tells a good story where we are anticipating rate cuts this year, and then depending which geographic area you're looking at, I think it's going to be somewhat uneven, but we are becoming increasingly confident that you're going to start seeing rate cuts in Canada as early as Q2 of this year, and then likely continuing throughout the balance of the year, and we'll get into that in more detail. But before jumping into that, I think there might be a few people on the call who maybe are less familiar with Middlefield or our fund. And just very briefly, Middlefield's been around since 1979. We're an equity income specialist, and we launched this particular strategy for UK investors in 2006, really as a means to provide UK investors with exposure to a Canadian-centric portfolio focused on equity income. And when we look at our North American peer group, we think our strategy really does stand out as being very unique. You have North American strategies, but the reality is they've got very minimal weighting, if any, to Canada, whereas within Middlefield Canadian, we have to have a minimum of 60% Canadian domiciled companies. And today, in fact, we're well over 90%. Just shows you our level of enthusiasm for Canadian companies, their ability to pay stable and growing levels of dividend. And as you'll see in the next few minutes, we think we've got a valuation backdrop that's as good as we've seen in the past 20 years or so. So with that, let's dig a little deeper into why we think this strategy makes sense for investors generally, and for UK investors in particular, as a means to get diversification. Firstly, we know the major headwind to equity income securities over the past 18 months or so has been the CPI backdrop. And as you can see on this particular slide, CPI in Canada has now come off quite significantly and is at the lower end of the range for most developed economies. And CIBC, a large Canadian bank who probably do some leading work on the direction of rates, have recently put out a note that, in fact, Canada would be one of the few countries in the developed world that actually includes mortgage interest in the calculation of CPI. So when you look at Canadian CPI ex mortgage interest costs, we're a lot closer to 1.5%. And maybe just as importantly, the Bank of Canada is now making overtures that they appreciate that point. So in fact, we are now ex mortgage interest below 2% CPI, which again is the reason why we're feeling increasingly confident that you're going to start to see rates come off here in the coming months, and as I say, as early as May or June of this year. So, and we think that likely continues throughout the balance of the year. The other important things about the Canadian market is that, we are a natural resource focused economy, and we're a net exporter of oil, natural gas. And again, as a result of the events certainly in Eastern Europe, beginning with Russia's invasion of Ukraine, as well as the war in the Middle East, which started last October, we think the world is now becoming refocused on the needs for a stable source of oil and natural gas. And Rob will get into that in more detail, but we think that also provides us with more of a tailwind, as opposed to being a headwind, as the market was more focused on renewables prior to February of 2022. So again, putting this together as to why Canadian equities are well positioned. Well, number one, and we'll get into this in more detail, we think valuations today are extremely attractive. Number two, those valuations are in fact supported by extremely solid fundamentals. And we'll give you a number of examples in our portfolio that we think confirm this point. And as we said, with inflation now coming back down, and interest rates, we think coming down with that, we think we'll now finally get some economic tailwinds, which admittedly were effectively headwinds for the past 18 months or so. So let's first focus on valuations. And this is a really interesting chart, because what it shows, going back, for the past 10 years or so, where the Toronto Stock Exchange is trading relative to global equities as represented by the MSCI World Index and the S&P 500. And when you just look at us relative to the S&P, we're trading today at a full 6-turn discount. When we're looking at forward earnings, we're at about 14 times relative to the S&P, which I think today is north of 20 times. And even when you look at the multiple, X tech, so we know that technology represents, and the Magnificent Seven, roughly about 28-30% of the S&P 500, which we know is at a higher multiple than the broader S&P. We think we're still at about a 3 to 4 turn discount X tech in the US. So again, this is attractive evaluation on a relative basis that we've seen really over the past 20 years. So again, we think the valuation backdrop is very, very attractive right now. And again, when we think about where we are as far as our 10-year yield goes, the US is at about 4.2% today. Canada is about 3.45%, and we think likely trending lower. And as I mentioned earlier, we think the short end of the curve is coming down as well over the next 12 months. With respect to fundamentals, again, the valuations are important, but you really have to look at them in the context of where fundamentals are. And we think broadly the Canadian market is well positioned, because we've got very strong earnings growth out of Canadian equities generally. When you think about the major parts of our market, whether it be banks, whether it be energy, the earnings profile is very, very strong, and we'll get into that in more detail in a few seconds here. And we're actually delivering that earnings with a particular focus on income. The Canadian market today is yielding at about 3.5% in terms of dividend yield, higher than that when you include buyback yield, relative to the S&P 500 with a yield of about 1.5%. And although rates are coming back down, we believe that they'll still be higher than that decade of 2010 to 2020. So again, there is going to be a focus on equity income. We really do believe that in the next 6 or 8 months, you're going to see funds flow back into equity income from cash and cash alternatives, which I think will again support the story for what we're holding in this portfolio. This is also a really important chart to keep in mind here, where we basically look at the Canadian outperformance versus global equities, really going back 40, 50 years. And again, we've seen periods where Canada's outperformed, specifically during periods when there was a particular focus on natural resources and less of a focus on growth. And I think that's really where we are today because, as I mentioned, you had a period where interest rates were effectively zero. The market effectively focused on growth, again, during this period of 2010 to 2020. We've now hit an inflection point over the last few years where we think, although, as I mentioned, inflation and interest rates coming down, we think that they'll still be higher than what you saw during that decade. And I think really positioned for a period where natural resources and really what Canada does will be very well positioned. And Rob will get into that in more detail in a few minutes. So, we think this is the time where you're looking at Canadian equities, and what we focus on in our portfolio is being very well positioned and very attractive from a valuation standpoint. The other things that are supporting this thesis is number one, we've got a population in Canada of about 40 million people, which is now growing at the highest level of any country in the developed world. We had about 450 to 500,000 permanent residents come in 2023, a very similar number looking at 2024, 25, and 26. So, Canadian population growing by about 3.5% over the next 3 years or so, which is very significant, as I mentioned, as high as any, if not higher than any in the developed world. And what's also important to understand is that, many of these people, and about 65% are coming in under what we call the economic category, i.e. people who contribute to the economy right away, i.e. not a drag on economic activity, but in fact contributing to economic activity. So again, we think that really does bode well because that has a positive spillover effect, not only on our demand for products and services, and that spans, the energy market, that spans financial services, that spans real estate, the three areas where we're focused in this portfolio. Here's a slide just on the background for me and Rob. Rob and I have been working at Middlefield for 25 years and 20 years respectively. We work very closely on managing this portfolio. Again, I think that's important because we effectively were there from the launch of this fund. So that continuity in management, I think, is important, especially as we've gotten to know what investors are looking for in our portfolio, and really highlighted by the fact that we're focused on income. We're identifying companies that are not only paying dividends and growing dividends, and that's effectively been manifested in the fund's ability to increase its dividend to investors over the last few years. We increased it by 0.1p in January of 23. We increased it again by 0.1p in January of this year. And again, just given the backdrop where we think we're seeing an attractive valuation with the fund trading at a discount, what I would describe generally as a double discount, we think is as attractive a period as we've seen for this fund right now. And that's really evidenced in our buying shares. You might have noticed that in the past few weeks, the manager, Middlefield Limited, has been buying shares in the market of the fund, knowing that we're seeing a very attractive entry point for the stock. This slide basically shows their performance going back since inception, and that performance has really been brought down in the last few years by the fact that the interest rate backdrop has been more challenged for an equity income fund. Again, investors have been moving to cash and cash alternatives, and we think you're seeing an inflection going back the other way and back into equity income, and we think that really does position the fund well. As I mentioned, we're got a fund with what I would describe as a double discount. Not only is the fund trading at a 15-17% discount to NAV, the underlying portfolio is trading at a discount to NAV. So I think this makes it a very compelling story. Focus on dividend growth. Again, 100% of the portfolio is invested in companies in high dividend paying stocks. Fully covered dividend in 22 and 23. That's been manifested in a dividend bump to investors in each of those years. And again, just adding some data to this where we've got 85% of the portfolio companies have actually grown their dividend over the past 5 years, and about 50% have increased it every year over that period, including the pandemic when the market was more challenged. So again, we think that dividend focus of the fund over time will really pay positive returns to investors on a very competitive basis. Let's focus a little bit on what we own in the portfolio. And as you can see from this slide, about 85% of the fund is focused on 3 areas, all of which we feel are very well positioned. What I'm going to do is just touch on the real estate area first, and then I'm going to turn it over to Rob, who will talk about energy and financials. So with respect to Canadian REITs, our fundamentals in this sector and our REIT exposure is primarily on Canadian REITs. We believe that we're seeing an entry point here that is supported by fundamentals in the real estate market in Canada. They're as good as I've seen over the past 10 years. In fact, I've been managing REIT portfolios here at Middlefield really since I joined the firm in the mid-1990s. So it gives me some real perspective because I've managing these portfolios through various cycles. So even though the broader REIT market today is trading at a 20% discount to NAV, our portfolio is closer to about a 15% discount to NAV. That wider discount for the whole REIT sector is really driven by the office REITs. We don't have any office REIT exposure in this fund, so as a result, we think our higher quality REIT portfolio, albeit at a lower discount to NAV, continues to be extremely well positioned because most of the REITs in our fund, pre-pandemic traded at a 5 or 10% premium to NAV as opposed to this current 15% discount to NAV. And we think one of the catalysts here to start re-rating the REIT sector in Canada will be lower rates as we start to see that, in the coming months, just the way you saw it in November and December last year. After the 10-year peaked in the US at about 5%, you saw real funds flow and a re-rating in REITs, and we think that's going to be the case again in the latter half of 2024. This slide really does cover, the 3 areas that we're focused on, all supported by very strong fundamentals and trading at a discount to what we think these assets are worth. Firstly, on the industrial REIT side, we've got, very low vacancy, well below the long-term average. We're seeing rent renewals in industrial REITs in Canada, 20 to 25%. Necessity-based, grocery-anchored, kind of open-air retail. These would be these open-air retail shopping centers that are anchored by a major grocer or a Walmart in Canada. Again, we've seen very new supply come on in those particular types of shopping centers. So you're seeing a very strong tenant profile. You're seeing significant rent renewals with limited supply. And when you think about growing population in Canada, most of which is coming to major urban centers, we think these assets continue to be well positioned. And then last but not least is our apartment REITs or our multifamily REITs. Again, we're seeing very, very low vacancy, i.e. less than 1% in most centers. You're seeing rent renewals that are significant as well. So when I think about some of the key companies that I own in this portfolio in the REIT area, we're seeing virtually all of them report Q4 numbers in the past few weeks that met or exceeded the estimates. We've seen a number of companies bump dividends. So a few of our industrial REITs have increased their dividends by 3 to 5%. Our grocery and retail REITs similarly increased their dividends by 3 to 5%. Our multifamily REITs, we've seen some in Canada increase their dividend by over 20%. So again, this is an area that we think is very well positioned fundamentally, and we think the last piece to the puzzle here to see a re-rating will be a reduction in rates here over time. And then, as I mentioned, we do have a number of office REITs. They continue to struggle. In the Greater Toronto area, the office REIT market is at about an 18% vacancy rate, and we think that's going to keep sentiment quite negative and will keep us on the sidelines for the foreseeable future here because we want to see a real sustained turnaround in fundamentals before we start entering that area. Having said that, the balance of the REIT portfolio we think is extremely well positioned. So with that, I'm going to turn it over to Rob.
Thanks, Dean. Yeah, why don't I spend 5 or 10 minutes on the other 2 main sectors that we have exposure to. Let's start with energy. I think you're going to see Canada more on the front page of news flow over the next couple of years, and it's really, I think, the industry in Canada, I think, will start to express the good things that are happening, and it's really starting from providing what the world needs right now, which is solving this energy trilemma of providing energy security, which we have in Canada. We've got vast both oil and natural gas reserves and resources, long life assets, which we'll discuss in a case study in a few slides here. Affordability, we've got low cost access to both oil and gas, and sustainability. We've got our oil sands producers have formed a group called Pathways that with their capital, in addition to government support, are financing carbon capture projects to essentially have carbon-free energy by 2050. And I think that'll be a big positive to, feed the fuel that the world still is using in a sustainable manner. And we're also providing the world with vast amounts of natural gas. So just the simple displacement of coal in the developed world, and hopefully in India and China, as they use less coal and their growth of coal slows down, they'll be using more natural gas. And the positive is, we now have a unique go-to-market strategy to get our oil and natural gas to global markets. And this is something that I think will be more observed by the world starting in May and June of this year. We've got a new oil pipeline, an expansion of our Trans Mountain pipeline that brings oil to our west coast, to the refineries in Japan, Korea, China. So that will start to flow. The pipeline operator has actually asked the producers to start to flow into the pipeline beginning in May of this year. So the second half of this year, you're going to see the volume start to increase. And the main takeaway there is, and what's positive for our oil sand producers, and we have two of them in the portfolio, Canadian Natural Resource and Suncor, is currently they're getting a $20 discount to what WTI trades for, because we're kind of at the end of the pipeline as we try to get our barrels to the Gulf of Mexico and the refiners in the United States. So as we've got another egress outlet, which is now the west coast of Canada, not all of our oil has to flow south to the United States. That should bring the differential down. Estimates are in the $12 to $13 range, with lower volatility around that number. And as we know, investors like certainty and less volatility. And so I think that's on the come for the next couple of years. So I see good things happening on our oil producers, and then secondarily, the same situation is happening on our natural gas business, which is building LNG facilities on the west coast of Canada. Those are going to start to get filled at the end of this year. So 2025 is really going to be the flagship year, where 10% of our natural gas production is now going to be exported off the west coast of Canada, again, to the LNG regas facilities in Korea, in Japan. So again, the same dynamics, getting better pricing, better volumes for our natural gas producers. So, we're checking these three boxes of what global investors and global users of energy are looking for: security, affordability, and sustainability. So I think Canada is something, very proud to be talking about here in the very near future. And I think that's going to build in momentum in the stocks. We're starting to get some green shoots in the energy patch from M&A. You may have seen some activity in the United States, and what's happening there are the big companies in the US are trying to get scale in the Permian. So the Permian Basin they've kind of figured it out, and they realize that is the best rock in the United States to get oil out, but it has a finite reserve limit. And, really, we're looking at about 10 years of really good locations to drill in the United States. And then there's a big question mark of where do they go next? Well, they're going to come to Canada because our oil sands have 50 years plus of reserves, which are going to be cleaner, more sustainable, and low cost. And also on the natural gas side, we're also, with that same dynamic, offering the United States in our Montney and Duvernay shale an alternative to the shale that they have in the United States that has 10 or 15 years of good reserve life. And then they're in the B and the C class locations, which just are not as economic. So we suspect there's going to be interest in global players and US players over the next 5 years coming to Canada, kicking the tires on some of our large reserve life properties in the Montney and the Duvernay for natural gas. So here on this slide, you can see just the, if I didn't show you what sector this was, you'd be very interested to invest in it. What sector has high ROEs, so very profitable, the blue line showing very low valuation, and debt almost zero. So this is a sector you want to invest in, and lo and behold, it's energy. And many of our companies are trading at 3 and 4 times cash flow at $75 oil and $3 natural gas. And that's where the strip price for natural gas is. It's $3 to $4 where you can hedge out the next couple of years. So many of our companies, if they wanted to, could privatize themselves with their own cash flow in 5 years and just go private and then just earn the cash flow. So that could be another source of funds, would be private equity coming to our very profitable energy patch, which has no debt. So once rates comes down, lower rates will solve a lot of problems in a lot of sectors for all global investors. But when rates come down, I think that'll be another cycle starter here for M&A in the Canadian energy patch. So let's spend a minute here on Tourmaline. This is one of my favorite energy equities. I've been following the company and the management team for over 20 years. Mike Rose, was the CEO, was just nominated CEO of the year, and essentially he's run other companies in Canada. One was called Duvernay, and that was sold to Shell, which many of the listeners here will be very familiar with. So Tourmaline is Canada's largest natural gas producer, and the natural gas that they produce is charged with liquids. So it's very profitable because not only are they able to sell their natural gas and more of it's going into LNG on the methane side, but the ethane, the butane, the propane, the liquids, because it's liquid rich, those trade at an oil price. So they're getting very high profitability. And you can see here on the chart, on the left side of the chart, you're seeing different stacks of colors. And at current prices, their cash flow, which is that blue chunk there, which is about $3 billion a year, covers their maintenance budget, which is $1.7 billion a year, their base dividend, which is about 2%, which is about $400 million a year, and their growth. So there's still excess cash flow at very low prices, which we're experiencing because of the warm winter that we had. But in the higher part of that chart, the horizontal blue shade, kind of looks like a cloud there. That's the forward gas price that they can hedge at currently. And those are some of the prices that they're getting on some LNG forward deals that they've signed with Cheniere and other companies. So they're able to, plan for 2 to 3 years here, and they've got excess cash that will either go for base dividend increases, special dividends, which they've been doing, buybacks, bolt-on acquisitions, infrastructure investment, and exploration. So this company has essentially net debt of zero, and they report tomorrow, and it'll be interesting to see if they announce another special dividend in one of the lowest natural gas price environments. So if they're able to announce a special dividend tomorrow when we've got gas below $2 per MCF, that shows you how stable and that the cash flows and the ability that this management team has to weather some of the worst trends. So this company checks a lot of boxes for us, and it has 70 years of reserves. So this is a company we think we could own for 70 years and, earn 8 to 10% a year on their free cash flow yield. So it's an excellent company. Unfortunately, we're probably a little bit uneasy given, in probably 5 to 10 years, there's probably going to be a super major in the world that needs those reserves and takes it over. And, we lose one of our favorite stars, but for, the next 5 to 10 years, we think Tourmaline will be a core part of this MCT portfolio and give us what we want, growth in share price, but also dividends in the form of both base and specials. Canadian financials, both our life cos, our life insurance companies, which are starting to come to life, and our banks have started turning the corners here. They're very cheap. Global financials are cheap. There's no difference there. But we think as rates start to come down, the banks in Canada are going to have their provisions for loan losses come back on to the off their their credit and reserves, and then back onto their balance sheet as earnings. So we're a bit early, but we think 2025 is going to be a really good year for the Canadian banks. And we're starting to see both wealth management in the quarters that just came out 2 weeks ago in Canada. The wealth management arms of all of our banks really shot the lights out on earnings growth, as well. ECM, so equity capital markets. Just in the last 2 weeks, we're seeing financings every night where equity issuances are happening because we're at all-time highs in the equity market. So that's a good sign for our banks like Royal Bank, Bank of Montreal, TD, all have strong equity capital markets arms. And then on the life cos, one of our favorite life insurance companies that we've added to over the last 6 months just came out with tremendous earnings. Their return on equity, Manulife here, the return on equity is at about 15%. The return on equity on this company was about 10 to 12%. So they're growing it to 15, but we think they can get to 20%. So we still see a year or two of valuation catch up on this company. They just bumped their dividend 10%. They're exposed to very good demographics in Hong Kong, Japan, Singapore, in their life insurance and wealth management business as well. They're focused here in Canada and the United States. So here's a Canadian player that gives us a little bit of global growth in the portfolio. Just bumped its dividend 10%. It's buying back stock, and again, their ROE, return on equity target's been reached. And given the transcript and meeting with management last week in Toronto, their next step is to move that ROE to 20%, which will again be very strong share price performance for the fund over the next 12 months. So in summary, these are a lot of the points that Dean make, but we are in a very good environment and an inflection point for what I see as a broadening of the equity capital markets. Tech has been great. That's where the earnings growth has been. But we're starting to see some broadening out under the surface in the market. You can see that in Microsoft, Apple, those stocks have stalled out here. And you're starting to see financials, energy stocks start to perform pretty well here in the last couple of weeks. And I think the next wave of tailwinds will be when rates start to get cut, whether it's in May or June, and the rest of the year, you're going to have money out of those money market funds, out of those 30-day guaranteed investment certificates, and that funds flow, both foreign funds flow and Canadian retail funds flow, will come back into dividend paying equities that will give them that 5% dividends that are growing. And I think that's going to be a powerful tailwind for both valuations, which we see, and share price performance here over the next 12 months. We're just on the cusp of that. So, Dean talked about the double discount. We're seeing that in REITs. We're seeing that in energy stocks. They're trading at such low valuations. MCI, which, the share price, the holdings we have are public. So, our NAV every day that we strike is, our feet are to the fire, and that's a true NAV because those are liquid blue chip Canadian stocks that can be liquidated or bought on a daily basis. So that's a true NAV versus a lot of the other investment trusts in the UK. You get a NAV once a quarter, and sometimes, as we've seen in the last couple of weeks, you've got a surprise to the downside on how that NAV is being valued. Our NAV trades every second of the day in the stock market. So, MCT at a 17% discount to the story we just told you, where we think some of our holdings are 15, 20% too cheap as well. It's a very compelling investment opportunity here.
Perfect. Thank you, Dean and Rob. Really thorough update. We do have a couple of questions, so I think we'll kick off with those. Just on that final point, is this the largest discount you've seen between global equities and Canadian markets, or have there been any lessons from history?
Yeah, we've looked back many decades, and typically the widest we've seen on a PE basis is what we are at right now, about 6 times versus the S&P. So even when the S&P was at a 22, 23 PE, we were at 16, for example. And then against the MSCI World Index, the max we've seen is about 4, and that's what we're at now, about a 4-turn discount to the MSCI Global World Index. So that trough, we don't see it widening any further, and I think we're on that inflection point, which is that buying opportunity.
And just on that sort of point in comparison to the S&P, MCT can allocate to the US. Do you have any US allocation at the moment, or is actually you just seeing the opportunity set in Canada as too good to miss?
One area that we're excited about, we manage a couple strategies here for Canadian clients in the healthcare side. So that's one area that we're looking to perhaps move, not a massive amount, but some of the portfolio into healthcare. And some of the best, most innovative companies are in the US that we found in the healthcare side. So you may see us allocate, up to 5% of the fund into that sector where we're still getting below, market PEs. We're getting growth maybe a little higher than we're seeing in some of the financials, for example, in Canada, plus some dividends. So that's an area that piques our interest, but the core of this fund, we still see vast, tremendous opportunities here in Canada.
And just looking at the core sectors within the portfolio, so you've just mentioned healthcare. We've heard a lot about sort of earnings reports in the US. Are there any key sectors where you are seeing earnings upgrades in Canadian markets, and more so the dividend increases? And perhaps you could worth highlighting a couple of examples.
Sure. Yeah, we've seen, earnings beats, but just gradual beats, the ones that you would expect from the quality companies we have that have long life assets with contracts and inflation protection in their contracts. So names like Topaz Energy, which is a mix of energy royalties and infrastructure. A lot of those contracts are inflation protected by 3%. And lo and behold, last night, they beat estimates by about 5%, and they bumped their dividend 3%. So they're doing what we want them to do, what we are expecting them to do. Given the story we just told, there shouldn't be many surprises in our portfolio where a company blows away earnings by 30%, right? We know RioCan, who owns those grocery anchored shopping centers, they just bumped their dividend by 3, and they are seeing rental growth. If they can get a low quality tenant out of their business, out of one of their leases, and a higher quality tenant in, there's growth of maybe 5 to 10% in leases, but it's not 30 or 40%. And that's just the type of investments. So yeah, AltaGas, Topaz, Choice Properties on the real estate side. I mentioned RioCan, Manulife we've talked about, CIBC, for example, on the bank side, just they've been cutting costs and they beat earnings, but by 7%. But those are little singles that we like to hit in this type of fund.
That's really helpful. And just moving into the real estate sector was one of the larger overweights in the strategy. We've been seeing a lot in the UK about the repurposing of office buildings here. Is that a similar trend in Canada, or?
The reality is, it's a great soundbite, but much more difficult to execute on. So, like the UK, we've got some older office buildings, and there's real bifurcation in the office market generally. New office buildings with great amenities, lots of natural light, great air quality, they're at 95% occupancy. 40 and 50-year-old office buildings that really don't have those attributes, they're sitting at 30 and 40% occupancy. So you're right that there's been lots of discussion around repurposing some of those old office buildings which by and large are obsolete. But as I say, that's a much more complicated discussion, because first and foremost, you've got the size of the office building, and in particular the footprint. So if I'm converting an old office building into a residential apartment building, every unit has to have natural light, and the bigger the footprint of that particular building, it makes it more difficult to have natural light coming into every unit. So you can't build a unit without any windows. First and foremost, that is the major problem. And then, clearly the cost of retrofitting a building from electrical to plumbing is also very complicated and expensive. Construction costs, generally speaking, are continuing to be quite high, and that's one of the reasons why you've seen very little new supply come on across all real estate sectors. And then the third piece to the puzzle is getting municipal approval to do it. In cities like Toronto right now, if I'm going to tear down an office building, I need to rebuild an office building. So because the cost of conversion can be so high, people are considering tearing down an old office building, but unfortunately the bylaws don't permit you in Toronto to actually put up an apartment building where an office building used to be. So bottom line is, there is no easy solution to this shortage in housing. And in fact, Canada has the lowest housing per capita of any country in the G7. And unfortunately, we think that's going to persist for some time, which basically means that there's going to be continued upward pressure on rents.
No, that's really helpful. And just I think we're time for one more. Moving back onto energy, to what extent is Canadian energy and your exports affected or impacted by Chinese demand?
Yeah, I think it's the narrative. It's a little more on sentiment recently, where the China demand worry on all commodities, and we're seeing it on what's happening on fertilizers, copper, oil, and natural gases. It's all been lumped in on narrative, but when you peel back what's actually happening, their use has been fairly stable and generally still growing, especially on the diesel side in China. And that's why global demand for oil still is growing at 3%. And there is some entities that think oil demand is going to collapse in 5 years, but I don't see that happening when some of the biggest populous areas, India and China, continue to use it as and both the natural gas as a main source of baseload energy and fuel, whether it's jet fuel or for industrial and commercial uses. So it's more of a narrative, and definitely that's affected. If you look at the commodity indices around the world, down 20%, that's affected the narrative and why both mining and energy stocks are trading at single-digit PEs, and many turns below where they usually trade. But I think we are troughing in China, and we're in that stage where we're going to start to see stimulus headlines over the next year. So when we fast forward and do this chat again in a year, you might start to see the green shoots out of China, the narrative change, and I think the biggest tailwind there will just be sentiment, funds flow back into energy stocks. And if they can trade at 5.5 or 6 times versus 4, right there is massive outperformance and tailwinds. So I think I'm actually not seeing much in the way of demand destruction coming out of China if you're looking at the actual physical barrels, not the financial barrels. And we all know there's a lot of fast money that just plays the futures markets on oil and gas based on sentiment, and that's what's been driving the funds flow.
Great, that's really helpful. I think just being conscious of time, we'll pause it there. And those questions you weren't able to address, we'll be sure to revert via email in due course. If anyone on the call does have any further questions after the call, please do not hesitate to contact your respective contacts at Kepler or Investec. And just like to thank Dean and Rob again for their time today. Hopefully everyone on the call has a better understanding of the diversification benefits on offer by Canada and more the valuation story. Thank you again all. And with that, I wish you a pleasant afternoon.
Great. Thanks, Ed. Thanks, everyone.
Thank you.